In this video, I'm going to demonstrate what mean reversion is and how it can be used in your trading. Mean reversion is pretty simple. Individual stocks will tend to follow a trend over a period of time. Over this time period, though, certain news or market forces will cause the stock to rise above or dive below the trend on a short-term basis. This is where opportunity lies. By identifying a trend in a stock, as well as how far the stock typically deviates from the trend, we can create unique and accurate trading signals. So how do we identify a trend? When most people hear the word trend, they think of trend in the most basic sense. This stock is trending up, this company's revenue is trending down, etc. What we're talking about, though, is just slightly more involved. What we're doing is creating a set of basic rules that we think the stock tends to follow and testing to see how right we are. Our first example will be the most basic. Here, I've performed linear regression on a chart of Apple over some arbitrary amount of time. This line is called the line of best fit. And of all of the possible lines we could draw here, this line is the closest to the stock price at any given point. It minimizes this white space between the stock price and the line itself. There's no line here that we could draw that would minimize that space any less. Next, we'll look at a 20-day moving average. Every point on this line is the average of the 20 prices before it. You can see that the stock price moves above and below the moving average quite a bit more often than the line of best fit. Sometimes it's more, like here, and sometimes it's less. This is closer to where we need to be. The problem with the moving average, though, is that it offers no predictive insight. It only takes into account the mean of the past X number of days, but doesn't really tell us much about future directions. This is why I like to use a method known as rolling linear regression, which I've plotted in yellow. At every point on this line, we've drawn a line of best fit as we saw in our first example. On the 20th day of the chart, we're saying this has been the trend of days 0 through 20. And then we step forward and we say this has been the trend on days 1 through 21, etc. You can see that this trend tends to hug the stock price a little closer than any of the other models. So why do we use a 20-day rolling regression instead of 18 days or 22 days or 40 days? When we subtract the stock price from our trend line, our rolling linear regression, we end up with something called a spread. This is simply a chart of how far above or below the stock price is from the trend. What we're aiming to do when we pick the number of days in our rolling regression is create a spread that is tradable. Tradable simply means that the spread tends to move above and below our zero line regularly and predictably. And when it moves above or below the zero line, it tends to turn around and revert back to zero around the same places. So you can see that this spread, all of the tops are near one another, and all of the bottoms are near one another, and there's a regularity by which it crosses the zero line. On this chart, we can see that the trend rarely exceeds a 4% difference with the stock price itself. So we can know that when it is approaching the 4% level, that it's likely to turn around. This rhythmic characteristic allows us to understand to a greater degree what the stock will do in relation to the trend at any given point. If it's low, we're confident it will turn around, and vice versa. Knowing this, we can buy the stock when it's below the trend and short it when it's above, with confidence that it will come back towards the middle. Let me show you an untradable spread. This spread is much less predictable, and it's difficult to know if the stock's going to turn back towards zero, go higher, or stay in the same area at any given point. You can see that it's harder to predict where the tops are and harder to predict where the bottoms are. You can see that for a while here, the bottoms never tended to exceed 6 or 7%, but then over here, we crossed 10 to 12%. And because the spread is less rhythmic and less predictable, we have fewer opportunities to trade. Our goal in choosing the number of days in our rolling regression is to create spreads which exhibit the characteristics of tradability. In the next video, we'll put this into practice on a live backtester by testing out rolling regression lengths, creating trading indicators, and evaluating our returns. Thank you for watching this tutorial. For more of this content and access to an insane amount of live and historical financial data, try out Trade Defender for free by visiting our website, tradedefender.com. Use the offer code REGRESSION for 25% off your first month. For any questions or comments, please contact us at support@tradedefender.com. Thank you.